And welcome to the Dorsey Report. You can read more at Google Sites, StockTwits, and Twitter. And today's report is for January 23rd, 2015. Looks like the ECB ended up coming in big. We'll talk about that and the implications for Europe's future. Look at how relative assets responded, and look at why capital seems to be going from North America to Europe. Rating Russia. Look at our S&P 500 action, some leading indicators, get an Apple update. You guys know I've been a big bear on StockTwits, and I'm sticking with that position. And for our premium subscribers, we'll look at a golden leading edge on Apple. So as always, please like, share, and subscribe if you like what you see here. So the big news was Draghi came out and actually surprised to the upside. Apparently the ECB will be making monthly purchases of all kinds of debt, including sovereign debt, to the tune of 60 billion euro per month. And it's going to be a very long program, slated to end September 2016. So that's 18 or 19 months, depending on when the program actually starts. The total program amount is going to be somewhere around $1.3 trillion in terms of US. And we can do a really quick back-of-the-napkin calculation looking at the US QE 3 and 4, which started in the fall of 2012, ended up adding about 1.5 trillion to the US balance sheet, and ended up adding about 3 trillion to US market cap. So if you're assuming about a 2x multiplier, and looking at $1.3 trillion, you're talking 2.6 trillion added to a European market cap of about 9 trillion. That ends up being about a 30% appreciation. So we could see Euro equities up very big over the next year or two, which is why I'm basically making the argument that the smart money capital flows are already moving toward Europe, and we can see that in the price action, but this is exactly why. U.S. markets have already seen that huge appreciation since about the end of 2012, and now European markets and Russian markets are going to see the same over the next 1 to 2 years. So more on that in a bit. Relative asset performance looks like gold, miners, and gold are still definitely doing very well on the month. We're also seeing emerging markets and Russia start to kind of pull ahead here on a 1-month basis. In terms of our laggards, looks like right now the oil explorers and production are still suffering, as is agriculture, the U.S. energy sector, and the U.S. financial sector. Tech has also been turning in a pretty poor performance lately, which I think is going to be a trend we're going to be seeing more of over the next year. In terms of that European inflows trend that we're seeing, we can see that very clearly here in the French CAC 40 versus the NASDAQ composite. Big turn up above moving averages. RSI is up at 65 now. I think this is going to be one of the big trends, is basically the U.S. tech sector has seen its best days, at least for the foreseeable 3-5 years, and I think that Europe is going to be benefiting from that capital flight. Also another trade that I recommended a few weeks ago, Russia versus Canada, is another indication of capital outflows from North America, due to the oil depreciation over the last year, due to the strengthening of the U.S. dollar, due to household debt to income ratios or sovereign debt to income ratios. For whatever combination of those reasons, we are seeing capital basically moving, in this case, from Europe to Russia. Very strong breakout here. Our RSI is up above that key 55 threshold, and I think we're going to see a convergence up here, adding on at least another 15, if not 20+% in that respect. In terms of Russia specifically, I had mentioned earlier that that Fitch downgrade a couple weeks back was a big contrarian indicator, and that was going to be a good sign for Russia, Russian markets, both their debt and their equities going forward. And part of the reason that I think is reinforcing that is the fact that Fitch was actually expecting capital outflows of $130 billion for 2015, and yet The World Bank, which tends to have better econometrics, is only predicting 105 billion. So Fitch is already, shown to be probably exaggerating on the outlier there. And the Russian central bank's own predictions are for 115 to 120 billion in outflows. So it looks like the limits where they're going to have to use currency controls are probably not going to be hit for 2015. And the silver lining, which I mentioned on Twitter, is that because of the embargoes and because of these financial reversals that are happening, a lot of Russian companies have ended up paying off their external debts early because they just can't get financing abroad. It's no longer legal, and so that's actually good for their balance sheet, paying off these debts early, and it's definitely going to improve their financial strength going forward. So looking at our leading risk indicators going forward, we're taking another look at the 7-day Chinese money rate here, 7-day repo rate. Looks like it has definitely come down quite a bit since that big spike in December. However, it is kind of flirting at a higher base here, something similar to back during the summer of last year. And it is above some of the a little bit longer rates. So we definitely want to see that drop another % maybe, and drop below the other longer duration rates before we know the coast is really clear for risk globally. Also, our 1-year leading euro-dollar COT here for the 2015 contract. Looks like these guys do reach a sort of peak net long position here, January 27th, 28th, right at the end of the month. And then they do pull back a little bit through about the first week of February. And then it looks like we do get a decent rally all the way into the end of March. In terms of the price action, we can see that as well. Looks like the end of January there is a little bit of a pullback, and then a rally, and then another big break off in mid-March here. So we'll see what happens, but the key takeaway is that it does look like there's going to be a little bit of a pullback end of January, first week of February. Looking at the action on the SPY, looks like we are getting a leading indication here from the rice futures, which tend to lead by about 3 to 5 trading days. We can see that it's been just about 2 days here that rice has been moving to the downside. So that means we don't have much more breathing room on the upside, even though we did have a nice breakout here due to basically front running and the actual news out of the ECB. It looks like the dollar-yen is also supporting the pullback in general risk. So that's something to definitely keep an eye on. We also have a, looks like negative divergence here on our MACD histogram here. We are on the hourly chart. So this is telling us what's going to happen over the next 2 weeks. So that's negative divergence, not something we want to see either. So definitely seeing some signs, some signals of caution here on the SPY hourly chart. All right, so the big elephant in the room over the last week has been Apple. I made my bearish case earlier last week at about 110, and we have seen good correlation between Apple and the broader equity markets. So Apple has been rallying through some key levels, although looking at all the way back to the rally that began quite a bit ago last year, the 25% retracement on that, and the 38% retracement on this current pullback that we've been experiencing since November. We're seeing a lot of convergence at about 113.8, which even in today's action we're seeing a price pullback from that level. So that's something to definitely be wary of. We do have earnings coming in next week about 127. Which is interesting that's basically aligning with the pullback that we're seeing in the broader leading indicators, or we'll just call it the euro-dollar COT, what those guys are up to. And we're also seeing a negative MACD histogram divergence here. So just comes in here. But yeah, we can see definitely lower highs here. So yeah, I mean, really the bottom line is we're going to need to see Apple back below 110 to really get technically bearish again. But I think that the biggest thing to me is more sentiment and valuation. In terms of sentiment, we're back at 88%, which we haven't seen since mid-late last November. You'll recall that was back when Barclays basically raised their price target from 120 to 140. It was right there at the end of November, and that was basically the high. We've been pulling back ever since, continuing to make a series of lower highs, and basically backtesting the 50-day moving average. So the fact that sentiment is at a similar level to that last major high, just below 120, is not a bullish sign. The contrarians would be going short just based on that. But then there's also terms of valuation. I've got a nice little valuation calculator here, which we'll take a look at. And this is purely based on some old school metrics. You know, Apple's market cap, 659.2 billion, income, we'll call it 39.5 billion, debt to equity ratio 0.32, and so right now we're seeing a fair value of $93, 93.4. And so for Apple to really be well valued, fairly valued, whatever you want to call it, we are going to see sub 100 prices. It's going to happen. I mean, it's no accident that we see the 200 DMA right around there, and also the fact that you know, if we take a look at the weekly charts, we've seen a lot of action basically between the 90 and $100 level. Basically, you know, May 2014 when we first broke above 90, all the way through about November when we had the big move there, was basically just a kind of a semi-consolidation between that 90 to $100 level. So to get back to that fair value, we're going to have to see some technical action in there, and basically yet another reason to say beware of the earnings next week, because it does look like there's going to be some disappointment. As always, thank you for watching the Dorsey Report, and good hunting.